You are listening to KeyStone Stock Talk Podcast, episode 115. If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at KeyStocks and on Facebook or via our 24-hour streaming radio station, pennystocks.fm. And keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold. This week, in our Your Stock Our Take segment, we take a look at Canadian microcap CCOM Satellite Systems Inc., symbol CMI on the TSX Venture, a leading global provider of mobile auto-deployed satellite antenna systems. A listener who made a great return on our recommendation on the stock in the past asks us our take on the stock today. Our second Your Stock Our Take is on a significantly larger business, US-based Yeti Holdings Inc., symbol YETI on the New York Stock Exchange, a global designer, retailer, and distributor of premium outdoor products. The stock, which went public in October of 2018 at a price of $17, has seen its share price rise over 209% since this time. A listener asks us how the company's current valuations stack up to our models. Our third question came in on GFL Environmental Inc., symbol GFL on the TSX, a large cap environmental services company in North America, which provides services such as non-hazardous solid waste management, infrastructure and soil remediation, and liquid waste management throughout Canada and into 23 states in the United States. A listener mentioned seeing a short report on this relatively newly listed public company and asks us our take on the stock from a fundamental perspective. Let's get into the show today. I'd like to welcome my co-hosts, Brennan and Aaron. How are you two doing?
I'm well. Good afternoon.
Yeah. Doing well over here. Doing well.
Enjoying the last parts of summer?
Oh, yeah. Yeah, got a fishing trip planned this weekend, actually. Gonna go fishing with my dad. Looking forward to it.
Yeah.
He needs to teach me how to fillet a fish. You know, I'm getting to that age where it's time to, put the Boy Scout the hat on and learn some things from him. So I'm looking forward to it.
It sounded like he said fill a fish, but I think he said fillet a fish.
Fillet.
Fillet?
Yeah, fillet.
Can you fillet it or fill it?
Well, I can do neither. So
I think Aaron just knows about the fillet of fish, and that's McDonald's. So we lost him a long time ago on that issue. So your dad's gonna show you how to.
Yes.
What are you fishing for? Is it walleye?
Yeah, it's walleye. So nothing that you guys see over in Vancouver,
no.
but walleye.
The chicken of the sea. You told me, right?
Yes. I was telling you that it is
of the sea.
Walleye.
Or of a lake.
Well, of the lakes, I guess. Of the lakes.
Of the lake,
yes.
It's true. They don't have too many seas.
No, it's delicious, though. Like, it's not fishy, which, I don't mind a fishy fish, but walleye isn't a fishy fish, so it tastes like chicken.
Of the lake,
it's awesome. Yeah, it's a chicken of the lake.
Yeah, well, you got to bring some out. And you could have some salmon. We get sockeye salmon out here.
I do love salmon. I do love salmon. Not that I've tried sockeye before.
No, it's a whole new experience. If you haven't had it, it's tremendous.
Looking forward to it.
And Brennan, you're talking about a company today that sells coolers. So
yes,
is this somehow related to your trip with your dad? You need a good beer cooler. So there might be. You found it.
There might be a Yeti koozie, a Yeti beer koozie on our trip. Keeping our wobbly pops warm. Cold.
Keeping them warm,
not warm.
And full disclosure, Brennan is not working a side deal with the company.
Yeah, he's trying.
He's not working a side deal.
Yeah, he would like to. No, we're kidding. So the final thing I'll touch on, the Canucks, our Canucks out here, round 2 of the playoffs, the only Canadian team to make it in. I'm not rubbing it in, but trust me, we don't have that much success out here. They evicted the reigning Stanley Cup champions from the bubble, so we got a day to celebrate. And much as what, typically what we expect in Canuck land, the next day we had a rude awakening at the hand of the Vegas Golden Knights, who trounced us 5-0. Game 2 is tonight, so putting some positive thoughts out there. Hopefully we can have a win tonight. That would be nice. Brennan, you wanted to take a stab at our intro topic this week, so have at it, my friend.
Perfect. Yeah, I wanted to pose a question to you guys just for a good discussion. So, it's been just over 6 months since the COVID-19 pandemic has rocked the globalized world, causing one of the largest and fastest broad-based market sell-offs in history. And personally, to my surprise, we have experienced a rapid V-based recovery in the months following, with the S&P 500 now reaching an all-time record high, almost as if the COVID-19 pandemic wasn't a cause for concern. So, the question that I want to pose for discussion is, are the markets showcasing economic reality? So first of all, I just want to make sure that our listeners understand that I'm not fear-mongering. We have no idea if there will be another correction tomorrow or if this is the beginning of a new bull market that will last for the next 5 years. But what we do know is that at the current level, markets are relatively pricey. And this is not to say that there will not be money to be made in the stocks, but we as analysts and you as investors need to be more selective and cautious with your capital as you deploy it, making sure you are investing in quality stocks that offer growth at a reasonable price, as it is here where there is money to be made. And it should serve as a solid case study that after the 2008 financial crisis, Ryan and Aaron were able to uncover portfolio changing stocks for our clients. So let's take a look at what we know now that the markets are at all-time highs. So many companies have begun to post what management teams say are going to be their most effective quarters by COVID-19, which is Q2 of 2020. And we can tell you from our research that a lot of these financial results have been dismal, but many companies have also continued to post impressive results. One of these names from our coverage is Expel Inc., which Ryan touched on as our star last week. So that's my first point. Just quite a few companies have been posting dismal financial results. So my next point here is bankruptcies have raged on in 2020. So we've seen a lot of prominent retail bankruptcies, including Pier 1 Imports, Roots USA, JCPenney, GNC, which is a supplement company. And we actually posed this company as a concern in one of our past dog segments almost a year ago, where we said, we wouldn't touch it with a 10-foot pole and their debt was unsustainable. So, maybe giving ourselves a little pat on the back there that maybe we called that one. And another big one recently in news was Lord & Taylor, which was actually the oldest U.S. department store, which just recently filed for Chapter 11 bankruptcy. And I would imagine that there are more to come from these big names. But what about smaller private businesses that we do not have much data on? Well, Yelp, the online reviewer, is showing that over 80,000 businesses in the US have shut their doors permanently between March 1st to July 25th. So, as no surprise, most of these companies are coming from the restaurant industry, retail and shopping, as well as event planning and whatnot. But you would expect that this trickle-down effect of less jobs, less money in circulation and spending would slowly affect the economy. But will it? Now, the last point here is we are slowly going to see the end of government wage subsidies, as well as debt payment deferrals. So have these benefits to society softened the blow or just postponed the economic impact? So again, the question that I'm posing here, are the markets showcasing economic reality based on what I've outlined, which include, weak financial results from many companies, numerous public and private company bankruptcies, as well as the end of wage subsidies. So with that being said, I'd like to open it up to Ryan or Aaron to get your guys' educated opinion on it.
Sure, Ryan, do you want to start off?
Sure,
I have a few
sure.
comments,
Yeah, you talked about a V-shaped recovery. That is for sure in the stock market what we see now. Many sectors on Main Street, and that's what you're referring to, really. And many sectors on Main Street are not experiencing that, and that's really the crux of the argument. So, if you look at something like retail, if you're a retail company and you are not on a strong footing ahead of the shutdown, ahead of COVID-19, you, in many cases, are dead. But those that were on a strong footing, I can see if you look forward, there is a potential to survive and then thrive. You look at retail, clothing, for example. despite Aaron's protest, we will continue to need clothes, right? For those that could, those that do survive this period could come out of here and will come out of here with less competitors, for example. So, there's an example of, if you were minding the store, if you had some cash in the bank, if you had decent cash flow, and if you had pivoted ahead of COVID-19, not after, if you had a significant amount of your sales online, you could move more sales online. And, my thesis would be, coming out of this with lesser competition, these companies, these strong names, could thrive coming out eventually as we have more of a recovery on Main Street. There's sectors, you got to look at it very individually, in my opinion, like commercial aerospace. There's a ton of uncertainty there in the near term and even midterm. So, it is a sector that we watch, but, I think you're avoiding right now, even, if you're playing for a recovery. There's so much uncertainty. The winners and losers aren't necessarily clear right now, given the evolving situation. And there's a number of other segments. There's segments that Aaron can talk about too that are doing incredibly positively. Anything that is digitized online and this has been a massive impetus to drive technological change, drive businesses online, virtualize businesses. Probably something that would have taken 5 to 10 years has taken 3 to 6 months. And, there's a huge benefit for some of the large cap. You're seeing a huge benefit in the share prices of all the FANG stocks in the US, but, you're seeing benefits there. So it's really sector driven. There's some sectors that are doing incredibly poorly, some sectors that are doing beyond any of the best expectations that you could have had. And then it starts to come down to valuations. Regardless of how rosy the future looks, you can't pay anything for a stock. So that's why you want to have somebody looking at the markets who understands valuations and how to value a company over the long term before you're putting your money, even if it's behind the hottest sector.
Yeah, good. Well said. And I'm gonna touch on sectors as well. I think we've discussed this before, and I've focused more on interest rates being literally at historic lows. We have valuations right now in the U.S. market, anyways, for the S&P that are as high as they've around the level they were right before the Great Depression, right before the big crash in the late 20s, and the second highest level. With the only other time the market being more expensive was right at the top of the dot-com boom. So valuations are obviously high, but interest rates are incredibly low. And there is an inverse relationship between interest rates and stock valuations. And one of the reasons for that is that the bond market, which is the biggest competitor for capital with the stock market, is literally paying people almost nothing. So you have funds, you have institutions, individuals with capital, and there's a lot of capital out there, given all the quantitative easing we've seen over the last 10 years, the low interest rates. There's a lot of capital out there searching for a home. It has to go somewhere. Where does it go? It goes to stocks. Even though valuations are high, there just isn't any better alternative or much of a better alternative. But we've discussed that before. But another thing I want to discuss just on the topic that Ryan was talking about certain sectors performing so well, for specific technology companies, particularly anything in cloud computing or anything that facilitates online commerce, the COVID crisis has been an absolute boom for them. When Microsoft put out its first quarter after the shutdown happened, the CEO said that he saw years of digitalization in just a matter of a couple of months. So many companies have done well. And I just did a quick calculation, Brennan, when you were talking about this. If you look at the market cap of the S&P 500, it's roughly around $30 trillion right now. Whereas if I take the top 5 technology companies, Facebook, Amazon, Apple, Google, and Microsoft, together, those companies have a market capitalization of over $7 trillion.
Wow.
So that's 25% of the S&P 500 just in 5 stocks, right? 1% of the stocks make up 25% of the market value. So when we're seeing these big moves in the S&P 500, they don't really reflect what's going on with the 500 stocks. They reflect really a lot of what's going on with the with the top companies, because it is a market cap weighted index. So that's a major factor as well, is that we, as Ryan touched on, this is really a tale of multiple markets. You have segments of the market where valuations are very high, where growth is strong, these companies are doing well. I mean, this has been absolutely huge for Amazon, with obviously their online commerce, but they're also the biggest player in cloud computing. It's been huge for Microsoft, who's a major cloud computing player, also provides software that facilitates a lot of this online workflow. So it's really a very segmented market right now, but somewhat concerning, absolutely, that there does seem to be such a disconnect. I mean, even if you look at the technology companies that are doing well, where the financials are strong, you're still seeing much higher valuations that we've seen even in recent history. So does that mean we wouldn't be buyers of the market? Absolutely not. We're still invested in the market. We're still finding companies that we can buy, but we would just be more cautious. We wouldn't just be piling on with everybody else and just expecting that we can extrapolate these returns out into the future over whatever time horizon. You always have to be a little bit cautious. Right now, people are more greedy than they are fearful in some areas, and as Warren Buffett said, that's when you need to be a little more fearful yourself.
Yeah, and generally, given the valuations, it's nice to have some cash on the sidelines right now, and cash if there is a time to deploy that. Now, again, we're not fear-mongering at all here. If we find a company tomorrow, and I know we're attending a conference with about 400 companies just to start September. If there's one or two companies there, companies that we've been doing due diligence on for the past month already, for example, that we like, we would not hesitate at all to deploy that capital if we think the business is trading at reasonable valuations, has growth, has a reasonable balance sheet, good management team. There's absolutely no hesitation to deploy that capital. It may be that we have cash on the sidelines because we can't find as many of those type of investments right now. It's not necessarily a call on the markets going forward. So let's get into our Your Stock, Our Take segment. It's time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold. We got 3 stocks that were asked from listeners this week, asked our opinion on. The first one we'll do is GFL Environmental. Aaron, you're going to take GFL.
Lucky me, yes. So an email from Marvin. He said, GFI Environmental has been in the news lately. The stock has dropped after a short report was released. Do you agree with the contents of the short report, or is there an opportunity to invest on this pullback? So GFI Environmental, symbol is GFL on the TSX, Toronto Stock Exchange. It's trading right now for about $25 a share. It's an $8 billion market cap company, which makes it a large cap in Canada. And what they do is they're an environmental services company in North America. They provide services such as non-hazardous solid waste management, infrastructure and soil remediation, and liquid waste management throughout Canada and in 23 states in the US. GFL is a relatively new entrant to the public markets, and it commenced trading via IPO on the TSX just in March of this year. The stock did perform relatively well over the 5 months subsequent to its IPO. It was up 36% until it hit a high in early August, and since then the stock has declined nearly 20%. The company was subject to a short report issued by Spruce Capital on August 17th. I've not personally read this short report. GFL's not under current coverage. It's not a company that's even high on our monitor list, so I don't plan on going through this report myself. But what I have done is I did take a look at the company's financial performance and outlook to see if it would qualify for further research at KeyStone. Based on what I've seen, the company would not meet our investment criteria. GFL is a growth by acquisition story. The company announced over $800 million US in acquisitions in June and an additional $1.2 billion acquisition in August. And growth by acquisition can be a very lucrative strategy if it is executed properly. It does appear that GFL may be trying to emulate other successful stories in their industry, such as a fellow TSX listed company called Waste Connections that's done very well over the years. However, from our perspective, the key ingredient that GFL lacks is current profitability. They have not yet proven that their own business is profitable, and this makes a roll-up strategy very risky. It also means that the company is more dependent on raising debt and issuing new shares to make those acquisitions. In the second quarter of 2020, the company reported revenue of $993 million, which was up 19% compared to the previous year, and they reported a net loss of $115 million, or negative 32 cents per share. GFL did report adjusted net income of 3 cents per share, but this is very slim profitability. Net debt as of the end of the quarter was almost $4.5 billion, and the company announced an additional $750 million US debt financing for its recently announced acquisition. So to answer Marvin's question, we do not see GFL as a buying opportunity at present. I'm in no way supporting the specific claims in the short report. However, based on the current financial performance, debt leverage, and strategic focus, we would consider GFL to be high risk, and it would really need to prove the validity of its business model before we would ever consider recommending it.
Yeah, no, I think it's a great summary. It's a company we will continue to monitor, but I think the valuations, even with a slight pullback there, are on the rich side. And as far as the short reports, just generally speaking, I would say it's akin to any real research report on a company. Some offer great insight and can uncover fraud. Some are very opportunistic and based mainly on speculation. And others, I would say, are not worth the paper they are written on. I'll give you an example. One company from our coverage, Trulieve Cannabis Corp, was issued a short report on it. A company issued a short report on it in December. The shares actually moved back almost 30%. We took a look at the report. We'd say there was more opportunistic. This would be following in that category, opportunistic and based mostly on speculation at that point. Since that report and the subsequent drop in and during a pandemic, Trulieve shares have increased over 170%. So there was an initial drop based on some uncertainty, but since that point, again, the shares have done nothing but go up, and the company has repeatedly reported, I think, 3 quarters of record growth since that period. So, that short report, over the long term, we'll look at Trulieve 2 to 3 years from now. It's in one of the riskier sectors. We say that Trulieve is one of the riskier companies in our coverage. But when you see from the base of that report, the stock going up 170% based on 3 consecutive quarters of growth, over the next 3 quarters since that report, that short report has not done a good job uncovering, a company that was significantly overvalued.
If I could add to that too, on that Trulieve short report, there was a company name that was attached to it, but there was no actual analyst names. From my understanding, I did end up reading the report. So like you said, Ryan, it might not even be worth the paper that it's on. So you really have to do your own due diligence and understand, that is just someone's opinion. And again, where is it coming from? You really got to take something lightly if it doesn't have any name attached to it, essentially.
Yeah, and as far as we understand, it came out from Grizzly Reports. There hasn't been much of a follow-up from the company. So, that would be one other thing that we look at. If you're, have a short report come out, continue to follow it up and provide, when they come out with continued financial results, go through those results and continue to hammer on why you believe that the company is significantly overvalued. And we haven't seen much of a follow-up there. And, the company continues to report record financial results, and if it continues to do that over time, that typically drives the share price. And a short report just becomes noise when you look back, 2 to 3 years from now. But we'll continue to monitor it. Now we're going to move to our second Your Stock, Our Take. It's time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold. That is on CCOM. I'm going to take that one. It's from Alex via email. He says, CCOM is a company you recommended in the past. I did very well on. What is your take on it today? Well, CCOM Satellite Systems Inc., CMI on the TSX Venture, trades around $3 today, market cap of $115 million. Its yield, it pays a dividend, is 1.8%. What does the company do? They design, develop, and manufacture transportable and mobile satellite-based antenna systems. Now, what is driving the stock? CCOM is currently developing some interesting new technology. Primarily, it's Ka-band, electronically steerable, modular, conformal, flat panel phased array antenna. Easy for me to say. The theory is, with the thousands of new satellites that are going to be launched over the next couple of years from very high-profile companies such as SpaceX, which is Elon Musk's company, Amazon, Google, Telesat, among others, they are changing the way broadband internet is going to be delivered around the globe. CCOM can potentially benefit from this, and investors are speculating on future business. Currently, however, revenues for Q2 dropped 58% to $1.06 million. The net loss for the company was $466,000, or under 1 cent or over 1 cent per share, compared to a net after-tax profit of around $267 million, or just under 1 cent per share for Q2 2019. Now, in Q2, the company continued to experience a slowdown impacted by the global shutdown. Now, the OPEC oil production dispute that dampened activity of CCOM's oil sector customers spilled into the early part of the quarter as well. Let's see our take on CCOM. CCOM has a great balance sheet with roughly $14 million in cash and zero debt. That cash balance is coming down at present, however. It is a good deal of current tech, and interesting future developments as well. However, the business is contract driven, and limited recurring revenues are in this business. As a result, it has low predictability. While the potential of the company serving a satellite boom is intriguing, it is speculation at this point. Based on current cash flows, the stock is richly valued at over 50 times EV to EBITDA. Quarterly results can be lumpy and can greatly uptick on a couple of large orders, but CCOM paid its dividend out of cash in the latest quarter, not operational cash flow, which is not a great sign. The company has takeover target potential given its technology and strong balance sheet, but with the global slowdown, it will make 2020 a very challenging year for the business. It appears the price right now is based on future speculation rather than current operating gains. We monitor but would not buy CCOM at present valuations.
And I think that another thing that's important for people to understand is at the start of the show, we were discussing, well, what are the things that are driving the market, with the markets going higher, particularly in the U.S., and even though we have so much economic uncertainty in front of us, and we identify technology as being one space that is kind of deviating from the rest of the market and driving a lot of those returns. I think is most of those, or a lot of that growth has been in the large cap space, but I also think that as the large cap companies, the valuations get higher, and people see that the share prices have gone up so much, there are a lot of people, particularly on the retail side, that then start to speculate down the chain. They start to look for other companies related to technology or related to other larger companies that have done well, and investing in those on a speculation that they're going to do well.
No, I think you're right completely. And I think that is occurring here, right? Like you're seeing that. You're seeing people extrapolating potential future. If you see, there's news every month about SpaceX launching or potentially launching a new rocket into space. People can easily identify with that, and they can see, well, this company has array antennas that are used on satellites and in conjunction with satellites. So this story can be made. The CEO is out there talking about it, and it is true. They have been a leader in this segment. So there is a story to be built around this that you can see the potential for future sales. We don't see them right now. The company is facing significant challenges in the near term. The potential future is there. But, if the markets are not in an optimistic phase, when we see a company having negative results, we don't typically see the stock going up. So this would be, a situation where I think the business is a solid business. And I think the balance sheet is great, but the underlying fundamentals at present certainly don't justify the market cap right now. And we are having investors potentially speculating on future business. When that doesn't occur, or if it takes 5 years instead of 6 months, you can have some pain in the near term. So that would be a company that, while it is a business we like, we think the valuation you're paying for it right now is a little high in the market and a little optimistic. So those are companies that we would look to avoid, given the fact that a lot of things have to occur right for this business to be priced higher in the future. Hopefully that makes sense. Now let's go to our second Your Talk, our Stock, Our Take segment, or this is our third, sorry. It's time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold. A big week this week. Tyler via email, he asked about Yeti Holdings Inc. Brennan,
Yes.
Since you and your dad are going to be using the product this weekend, you might as well talk about it.
Yeah, no, I will, for sure. So Yeti Holdings Inc., YETI, on the New York Stock Exchange, currently trading at a price of $51.43 and has a market cap of $4.4 billion. So Yeti is a global designer, retailer, and distributor of premium outdoor products, from coolers and drinkware to backpacks and bags. The company's products are built to meet the unique and varying needs of diverse outdoor pursuits, whether in the remote wilderness, at the beach, or anywhere life takes its customers. So the key points here is that Yeti is a relatively new story. They initially started in 2006, but IPO'd on the market in October of 2018 at a price of approximately $17. And since then, the stock has performed very well, now up over 209% from its IPO price. So this strong share price performance has been driven by solid growth in the company's financials. Just to give you an idea of the company's revenue trajectory, 12 trailing month revenue for this period increased 14.5% compared to the same period last year, which ranged from Q2 of 2019 to Q3 of 2018. But looking at more recent financial results, this is for Q2 of 2020, revenue was up 7% to $247 million compared to the same period last year. Adjusted EBITDA increased 24% to approximately $58 million, and adjusted earnings per diluted share increased 38% to 41 cents per share compared to 30 cents per share for Q2 of 2019. So the company has a reasonably healthy balance sheet with a net debt to EBITDA multiple of 1.7 times, indicating they should have no problem paying off their debt, and a debt to equity ratio of approximately 2 times, which might be getting a little high, but I don't believe it is any cause for concern right now. On a relative valuation basis, the company is trading with a trailing enterprise value to EBITDA valuation multiple of around 24 times, which I would say is a premium price for a premium retail good manufacturer and supplier. So our take here, as I said earlier, I can personally say that Yeti has helped me keep my beer cold on a hot day at the lake. And they have certainly grasped the title of the Cadillac of beer koozies and coolers and have secured themselves brand recognition for their high quality products. Just to show you how they have priced their products accordingly, a simple Yeti utility or beach bag can cost you over $200. Their drink koozies are around $40, and their coolers range in price from $250 to $700. So pretty pricey. But ultimately, the company has been able to back up their premium products and prices by generating solid financial performance in both top-line revenue growth and bottom-line profitability growth. So due to COVID-19, the company has refrained from providing financial guidance for the rest of 2020. But on a trailing basis, as I said, they do trade at a premium valuation for a retail good company, and they might not have much room for additional debt on their balance sheet, as although their debt multiples are reasonable, they are getting slightly extended to the upper end of where we would like to see them. So the industry that they operate in does have low barriers of entry, which could be a cause for concern. As just a quick Amazon search for coolers and koozies, you will find numerous knockoffs. But again, Yeti has secured themselves solid brand recognition, which is positive for the future success of the company. But all in all, to conclude here, based on their premium valuation, low double-digit revenue growth, and slightly higher debt multiples, right now we do not believe the company offers growth at a reasonable price. But I'll definitely be enjoying my Yeti koozie to keep my beer cool this weekend.
Good to hear. Good to hear. Yeah, and I think the summary is Yeti, good company, great success story. Trading at premium, high valuations, does have growth, but is it at a reasonable price right now? If there is any disruption to that growth, that's when you get into a problem. So, that's the way we would look at the business. It is certainly trading at a premium multiple at this stage. Great success story. Do we have a margin of safety here with the business? Likely not, given the fact that it is trading at those premium valuations. Aaron, any comments on that? Or are you good?
Well, I think that the big takeaway for me is that Brennan has a Yeti cooler and he's been going out to the lake drinking beers and he hasn't invited us. But aside from that, I would agree with most of what you've said. It's certainly an interesting company. When I first started hearing about the coolers as a customer, I was interested, but premium price product, not a big company. $5 billion, so good brand recognition now, but it's not like they're an extremely dominant company. $5 billion market cap in the US is still considered a small to mid cap. So you'd have to worry about those knockoffs, but as long as they can keep a cool brand and no pun intended, and come out with good products, then we would consider them in the future if the valuation were to enter a range that we thought was reasonable.
Excellent. Well, that's going to close off our show for this week. I'd like to encourage you to keep your questions coming into our Your Stock, Our Take segment. And remember, we have an Ask Us Anything segment, so if you want to know valuations of the market, anything like that, you can send your questions in for that. I'd like to wish everybody I think we're coming up to a long weekend here, a happy and safe long weekend. Stay safe out there, and I'll wish you all, going into the fall, profitable investing. Thank you.
Profitable investing.
Thanks, everyone.